Hello and welcome to the Harwood Report for January 29th, 2018. I am your host, Keith Harwood, the founder of Trade Academy. Standard disclosures, all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Everything I talk about here is the way I am looking at the markets. Do not take that as a trade recommendation. There's a lot to cover here. I'm going to look a little bit over the dollar and the VIX as well as everything I normally go over here. And so since I've got so much to cover, I'm going to get right into it here. First off, fear and greed, 72. It's still high. It was at 79. It's not coming down much here. I don't think this is something to be panicking about, but at the same point with the move back today, VIX staying firm, there's some signs that maybe we get a little bit of a pullback. That's not a break in the markets. A pullback is a different story. I think we could see something there. We could also just turn right back around and make new all-time highs. We've got a lot of information coming out this week. And that's what I'm looking at here. We've got the Fed on Wednesday. We've got non-farm payrolls on Friday. That's going to keep a little bit of a bit to vol. People need to have hedges on. So that's a little bit of, I think, why the VIX is staying firm. On top of that, earnings this week. We've got three big ones Thursday after the close, in particular, Apple, Amazon, Google. Obviously, Visa is big. There's just a lot of big earnings this week. And with big earnings can come a little bit of a vol bid. So we've got a vol bid. And that's helping pull the market back down a little bit because when vol gets bid, people are looking for the best way to hedge. They can either sell their positions or buy the VIX. Well, the VIX isn't cheap right now. The VIX is here, almost to 13 now. Sometimes we get these spikes up to about 14. That's usually the capitulation final seller of the market, final buyer of the VIX. Obviously, sometimes we can get even bigger moves up towards 16 or 17, but it seems to me like we're getting close to the end of the VIX bid, especially because tonight we have the tonight we have the State of the Union. We have the Fed on Wednesday. We have the earnings on Thursday. We have non-farm payrolls on Friday. We have a lot of information that's going to come into the market, take away a little bit of the uncertainty. Unless something comes out really, really bearish from one of those events, the VIX is going to have to get hit this week. And so that's the framework I'm trading off of. Is the knowledge that the VIX should get hit as we go into Friday. The market should then start to firm, unless really the one that I would be concerned about for me is non-farm payrolls. The Fed is what the Fed is. State of the Union is going to be probably pretty vanilla. Earnings, that could be a little bit of a concern, but frankly, one bad company earnings, even though they've got a lot of them this week, Amazon, Apple, Google, and many more. I just don't know that, from everything I've read, it doesn't sound like we should expect overall negative earnings. It could be a case-by-case situation, but I think overall the market should continue to firm this week after all of this news comes out. And so my first kind of play is looking for ways to be short the VIX as a result of that. Going back to SPY. So on Friday, we closed at these ridiculous highs. We're getting this pullback to here. We're staying above the January 24th high, which was 284.70. Everything looks like it's okay here. This is just part of the consolidation. When we have a big move on Friday, you can have a bigger pullback without really breaching any key technical levels. This is not an incredibly problematic number. We're still above all the key moving averages. The Qs look very similar. We are below the January 24th high in the Qs, but generally speaking, it's a consolidation move for the Qs. IWM has been a little bit weaker and is pressing back to test the 10-day moving average. This has generally been a decent buying area for IWM, but this would be maybe the first sector to show some weakness. Now that said, IWM is outperforming the Qs today. It's starting to come back a little bit. One thing I want to show you here is the spread between the Qs and IWM. This is just the difference in the prices, the green dotted line. It tends to peak out around $6 here, and it's up to 10. This, and almost 11, honestly. So 1082 right now, 1083. This is a big spread between the Qs and IWM. I've been looking for this to revert back to a more normal level, probably down to about 5. And generally speaking, when we see that happen, these reversions occur with IWM playing catch up and the Qs trading sideways. Again, you see it here. IWM played catch up while the Qs traded sideways. And again, here, the Qs actually pulled back a little bit while IWM was sideways in that one back in May or June. So to me, that sets up a little bit of a minor bearish lean in the Qs. I'm a little nervous about that going into all this earnings this week. If they come out great, Qs are going to skyrocket higher. But I think that that IWM has to continue to play catch up to the Qs. I don't know that this spread is going to go to $13 or $14. So even if the Qs, if the earnings on Thursday night come out good, IWM, I would think, would have to continue to firm. So the first thing I'm really looking at here is, again, we always look at the vol. Spider vol is at the highs. Q vol is at the highs and even higher than spiders. But that's because of the earnings coming out, and so that makes some sense. IWM is just starting to catch up now. It's up to 14.5%, 15%. For me, if I see the Qs trading, say, sideways or even down $1 to 169, IWM could still get to 164 in that scenario over the course of 2 to 3 weeks. So I have a little bit on already, playing for some rally next week, but what I'm looking at now is more of a calendar type play because of this vol bid that's coming into the front, looking into February 23rd. And since I'm looking for a move towards 164, 165, I want to be in something more like the 161s. So what I'm going to look at here is the February 23rd 161 call versus the February 9th 163 call. This opens up a pretty nice window for me, and at $1.20, this can easily, if the market just skyrockets higher, this goes to $2. But I think it could appreciate a lot more than that because these 163s may underperform into a rally as long as it's not a spiking higher rally, and give me a lot of leverage if those expire worthless, and then the rally continues. So I get a lot of leverage through something like this, and so that's kind of how the first way I'm playing this. It's very nuanced, a little bit more of a complicated trade, and part of the reason is because vol is not cheap. If vol is cheap, I can go long outrights all over the place. But in this scenario, vol is not cheap enough for me to just simply buy calls. I have a little bit on, as I said, to have some gamma, but I'm looking for something more of a diagonal here to reduce my theta bill in the fact that historical volatility is closer to 12% and implied volatility is around 14, 15. So that's how I'm looking at IWM. Let's go back to these charts here. Dollar. So the dollar overall has been incredibly weak. It's showing some support here. This is creating some weakness in gold, but the key for gold is and continues to be dollar yen. That's still an inside day there. So I struggle to get incredibly bearish on gold. I have some stuff on that's now getting in the money, and I'm actually looking to take that stuff off at this point. These are on the put side because I do think that the dollar should continue to firm. It was overdone, but I've got to see this firmness in dollar yen in order to get truly excited. On Thursday night, I posted a blog post, and part of it was talking about this as well. XAU JPY. We see that this has really confirmed a break here. So people are not buying gold in Japanese yen terms. So if that breaks and dollar firms against the yen, that's very bearish. I thought those would kind of go hand in hand. The gold break against the yen has been driving the gold market a little bit lower in spite of a lack of break or bounce back in dollar yen. But as this dollar yen starts to bounce back, if we can get above the 10-day moving average is crucial. If we can get above there and this goes to 114, we could have a massive break in gold. And if it can just firm up above Friday's high, which was 109.78, then that starts to give me a little bit more confidence that this is the start of that massive break that I'm looking for. So in the short term, it's a trading environment for gold. In the long term, I am looking for a structurally large bearish position. So let's look at gold and start thinking through where I think this can go. First off, gold is just retesting the 10-day moving average. Yes, it's bearish today. This isn't a huge bearish play yet. I'll keep some stuff on just in case this stuff gets ahead of itself, but I'm not going to be massively short yet. I do think that if dollar yen gets back up to 118, that 121 is not going to hold. We're going to be pushing back towards 116, 117. It's going to take some time. We may be a month or two away from that. That means I have a month or two to try to make money in this trade. A month or two to structure trades that are bearish gold. I have a lot of time to play this trade. I don't have to be leveraged short today. The ones that I think have some really good potential on that note are GDX, of course. This 22.5 shouldn't hold if that's the case, and neither should really 21. Maybe we get all the way down to 20 in GDX. GDXJ, same concept. We're going to probably push down into the 20s if this dollar yen firms back to 118. That's a big move in dollar yen. We're at 109 right now. But noting how long it took us to get from 114 down to 109, this is really only about 2 to 3 weeks. we can get right back up there in 2 to 3 weeks. We just need probably about 3 days of consolidation near the lows, then a cross over the 10-day moving average, and then the big push higher. Finally, silver. It had a really big run last week and has had a really big pullback today. I could see SLV down into the 14s, and I could see this one breaking first because we're already back into the consolidation area, and I've talked about this before. And so that's where I go for my next idea. I'm in some SLV puts, but let's first look at the vol. Silver vol is near the highs, but not crazy. Gold vol is at really the recent highs. We can get a little higher, maybe to 12%, but 11 is pretty high there. So silver, 18.5. It's not, we can easily get to 21. There's a lot of room to run there. And then the miners, 24, we could get up maybe to 27 or 28 in the short term. GDXJ could easily get up to 32, 33. So gold vol is probably the most expensive. Silver vol right now is probably the cheapest, given how close we are to that inflection point of a break. Right now, I have some of next week's 15.5 puts. This might not be enough time, but for a lottery ticket, this is a really interesting way for me to play it. I got in closer to 17% vol. I think I'm actually in for 3 or 4 cents. These are really cheap. These could explode. If we repeat today's move on the Fed minutes or the Fed decision on Wednesday or non-farm payrolls on Friday, we could see these things in the money fast. So I like those right now, but where I'm really focusing my positioning is a little further back, February 23rd, and I'm going to be looking at these 15.5 puts I'll see if I can get some for 8 cents since I think that we may get a bounce back. So I'm looking at February 23rd, 15.5 puts for 8 cents. Again, I'm looking for that potential for a move below 15 in silver when this major top is confirmed. So I like those already, and I'll really like gold and the miners once that dollar-yen move is confirmed. So that's a second idea that I'm kind of looking at to start this week. A lot of that will change over the course of the week as volatility levels shift and price levels shift, of course, and as we get the information from State of the Union, Fed, earnings, and non-farm payrolls. All of this has to be accounted for as I go through my trade concepts. All right, so that's where I'm looking in the precious metals. Let's go over to oil. I'll start with USO, having a little bit of a pullback today. This is also dollar related. I actually saw an interesting chart this weekend, and I can't remember who showed it to me, but the euro versus dollar has been very correlated to oil. You can see that the chart actually looks pretty similar here. So as the euro weakens against the dollar, that's been a little bit bearish for, for crude. Still above the 10-day moving average. Everything still seems relatively bullish here. This looks like a pullback the same way the market's seeing a little bit of a pullback. So I think overall this is fine. This is the normal course of business. And so I'm looking for buy the dip opportunities in XLE, which is now below the 10-day moving average. So maybe I have to wait a little bit. Nothing crazy here yet though. OIH, of course, is my leverage play, and that's now below the 20-day moving average. This is the one that really has the leverage, and it's at a bigger pullback. It's below the 20-day moving average. If I look over here at volatility levels in XLE, we're near the highs here, close to 18%. This is a lot like what I was saying in gold. It's already kind of pricing in the high vol. OIH has some room to run. Again, I could see this into the 30s. I've been playing around. I haven't gotten into anything yet here with this, but I'm just looking at this volatility in March, and it just seems too cheap. So before I'd been looking at the February 23rd 30.5s. I think those may be a little bit too high for me to get too excited about today, especially with vol a little bit bid on the upside. I kind of want to add a little more time because this vol is not that expensive. It's not cheap, but it's not expensive, and I've got some vol bid to the front. So what I'm looking at here is just go to the very liquid March contract. The 31 calls for 30 cents seem pretty cheap to me, given the potential here for that move to 32 or 33 if oil continues higher. Remember, oil is at 52-week highs. If OIH just gets to the 52-week high, we're talking about a move back towards 37. I don't expect to see that kind of move. There was some damage done to these oil services companies with oil at lower prices, but I don't see a reason why we wouldn't see prices can start to move up into the low 30s, 32, 33 range. And so a March 31 call for 30 cents gives me some good leverage for that type of move. Finally, I didn't touch yet on TLT. This all goes in line with the Fed meeting today. I still believe that this next move should be down to 121.5 or 121. So the Fed meeting is on Wednesday. That could create a different scenario. Vol has gotten a big bid in TLT as a result of the prep for the Fed and all the other news this week. I want to get through the Fed meeting before I go into anything crazy there. But I think the next move is going to be down towards 1.5, with Wednesday being a potential changer for that. But I don't see why they would really change course to be less interested in raising yields given the market reaction overall. This market move has been incredible. Why wouldn't you want to still raise rates given that the economy is showing so many signs of strength? So I think that overall TLT is probably looking bearish. Fed's going to be an impact, and I wouldn't be surprised to see a sub 121.5, maybe 121 move for TLT. And then we get maybe that bounce back the way that we have during this whole thing, and then I start looking for that move down towards 119. So I'm not going to really play for much for this move to 121.5 because I only have 2 days until the Fed announcement. But I am going to start looking for ways to position for a move down to 119 longer term, maybe over the course of a month. And I'll talk about that more in the premium newsletter that'll be out in a little bit. Speaking of the premium newsletter, that's the Harwood Report premium product. It outlines the ETF technical analysis and options analysis that I go through for all of the equities, indices, all of those gold miners, silver, oil, TLT, and talk about how I pick my best option structures for each of those setup. The first month of it is for free. So if you sign up now, you get a month for free. That seems like a pretty good price. There's no cost to you. After that, it's $49 a month, so it's still very cheap. But, I urge you, just take a shot with it, see what you think. If you don't like it, you cancel, cost you nothing. Go to tradeacademy.co/Harwood Report to check that out. And finally, you can always email me, keith@tradeacademy.co, or call me 312-600-8004 with comments or questions. Thanks, everybody, and I will hopefully see many of you reading the newsletter this afternoon.